You're coming off this $4 billion investment from University of California Regents. A lot of this is for BREIT. It is for your Crown real estate fund, a lot of retail investors in it. $4 billion is much bigger, obviously, than the typical retail check. But this is coming after a wave of redemptions as reported over a period of time. So what is the $4 billion really accomplishing for you at the end of the day? Is it filling the hole from these investors, or is it giving you something new to do?
Well, Shonali, Happy New Year. I'll just start with a little bit of background here because this is a big win for us. It's a big win for BREIT. It's a big win for the University of California, who's making this investment. $4 billion of common stock into BREIT with a minimum effective hold period of 6 years. It is a massive affirmation of the quality of the portfolio we've constructed, of the values of the assets here, and the performance outlook. All of that, of course, is quite good for our investors. And this is something that came about really because of the news media telling this story on BREIT. In many cases, we disagreeing with that. And Jagdeep Boucher, the longtime CIO of the University of California's $150 billion investment fund, reached out and said, hey, is there something we can do together? We came up with a mutually beneficial structure, and then he and his team spent the last few weeks seeing real estate, looking at our portfolio, meeting with our portfolio company CEOs, understanding valuations, liquidity, and as a result, getting very comfortable in making this large-scale investment. So I think the biggest thing here is just a validation of BREIT, particularly given all the noise out there and some of the what we think of as incorrect analysis. In terms of what we do with the capital, well, we have a lot of options. We've obviously got a dislocated market out there, which creates opportunities. Some investors are seeking redemptions, although it's much smaller than I think the media has indicated. In fact, in December, after 8 weeks of negative press, we had just 3% of U.S. investors looking for redemptions, 5% of all of our investors, but some capital can go to that. We've got a lot of options, and it's nice to be in this position today, particularly after enduring some of this that we didn't enjoy, and now being able to clear the record and have a major investor so sophisticated come in at scale.
Hey, John, you know, one thing about this investment, as far as the terms go, they do have a preferred minimum return that they're going to be getting. It's something that's guaranteed to them. Why wouldn't another average investor look at this and say that's preferential treatment?
So the way to think about this transaction is they're actually coming in as a common shareholder at the BREIT level with this $4 billion fresh investment. They're taking that investment, and then we're taking $1 billion of our existing holdings and putting it in this strategic venture. It does give them a minimum return. It gives us some upside participation. But I think the things to keep in mind are, one, the validation I talked about, and two, just like in our large institutional funds, big investors do get differentiated consideration. So if you think about it, their investment here is $4 billion. A typical BREIT investor is $70,000. A typical investor can seek liquidity beginning a month after their investment. Here, effectively, it's 72 months after their investment. And so these things are very different fundamentally, and the additional considerations coming from Blackstone, they're actually paying the full fees that any of the traditional BREIT investors are inside the vehicle. So we think, as we said, a big affirmation and a real positive for BREIT.
You know, it's interesting because BREIT's own performance last year outstripped the market pretty meaningfully here, more than 8%. Over 3 years, almost 15%. But the question here, too, I have is last year, hedges really helped the portfolio. Do those hedges start to subside in performance this year? And what is the thing that will bring you upward this year?
So I think the key when you look forward, and ultimately is the performance of the assets. You're correct that we did get a big boost from the hedges we put in place. We hedged out the debt for 6.5 years smartly when rates were lower, when we were concerned about inflation. That gave us about $4 billion of value gains. It was very helpful. As the long end of the curve comes down, we won't have the tailwind from that, but we will have the tailwind from potentially lower long rates helping the value of this $130 billion portfolio. And over time, that should be quite beneficial. The other tailwinds here are the rents in place in the portfolio are about 20% below market. The market rents have continued to grow despite the economy slowing. They were up in this portfolio 10% in November. And then longer term, what we expect to see is a lot less new supply. You've seen it in the housing market. I think you'll see it in the logistics space as well. Those are our two big holdings, as you know, in BREIT. And less supply is key because ultimately the value of real estate is driven by supply and demand. And that gives us a lot of confidence as we look out over the horizon.
Do you see more opportunities? You had some meaningful sales last year. Do you think that there's more opportunity to sell into this market, whether it's because of market pricing or something else? Would it help you really build the value of this portfolio to do that?
Well, I think that's one of the tools. I would say the most liquidity in real estate today is in the rental housing space, multifamily apartments, and we have been selling some assets there. We'll probably continue to sell some. Other areas, there are opportunities. And I think one of the important things, Shonali, people think about BREIT as a real estate portfolio, but had we owned for sale housing or had we owned office buildings, it would have been much tougher. And so I think there'll be opportunities to sell in some sectors and hopefully some good opportunities to deploy capital also.
John, before I let you go, about 30 seconds or so here, victory lap for Blackstone. You guys were so early when you had predicted that interest rates would go much higher than anyone had thought. Joe Zeidel said as high as 5%. And that was when banks were still saying 3%. So where do you think they go this year? Do you think that the expectation of cuts makes sense?
So it's always dangerous getting into interest rate predictions, but what I would say is, given the fact that inflation is starting to come down, particularly in things like shipping costs, commodities, the labor market is cooling a bit, but is still too tight from the Fed's perspective. I do think the Fed will stop raising rates in the first half of the year, but my expectation would be they would hold rates at those levels through the balance of the year, even as the economy slows. I think the long end will stay inverted because people will think over time the Fed will cut and the natural rate of interest rates lower. But I think for the year, we'll get to this level somewhere around 5 or low 5s. The Fed's likely to hold there and the long end to be at a lower level given the expectation of a slower economy.